G'day, Paul from Small Crown Productions here, and welcome to the Business of Art. On this channel, I dig into all of the things that we need to help us build a business around our creative work. So tips, tools, strategies, interviews, mindset, whatever I can do to help share knowledge from people who know what they're talking about so that we can do business better and make money from our creative work. So if that is something you are interested in, please consider subscribing. This video is one in a series of over 15 videos relating to tax and finance for creative people in Australia. So this is specific to Australia. It is also general advice. Always, always, always seek specific advice about your situation in your region or country where you are. What I did was ask my creative network for a question that they would love to ask a tax and finance specialist, and then I bundled them all up and took them to Matt Tucker, the principal of Creative Crunches here in Brisbane. Creative Crunches is an arts-focused accountancy firm. Matt and his family and his team have been serving the artistic community here for many, many years. Matt was super generous to donate his time. I cannot thank him enough for taking the time out of his day to actually sit and answer these questions for us all. So with that, let's dive in to today's question. If my arts business makes a loss, can I write that off against the income from my day job?
If you've got this business and it is in its early stages and you're spending more money than you're actually earning from the activity, and the business produces an actual loss, what a lot of clients want to know is, well, how is this balanced against my income from my part-time, full-time, casual work? And there are another set of rules called the non-commercial loss provisions, which have something to say about that interplay, because the general day job is usually employment-based, employer-employee, and there's no question that income is assessable. It's wages and salaries, and it usually sits at a particular section of the tax return, and you kind of take that as a given. And the next question is, well, if the business has actually made a loss, which is stemming from the deductions, then are those deductions actually going to act as a tax deduction against my income from something which is all the way outside of the arts? Yep. And the non-commercial loss provisions is an extra body of law that you do need to go through various tests to see whether that loss is going to be claimed or able to be claimed against your other income. Now, that's a whole second set of rules. There are general exceptions which are applicable for arts workers. It doesn't exempt everybody, but some of those arts workers will be exempted from the tougher provisions, and they might be given an avenue to be able to claim those losses, whereas other people not working in the arts would actually be subject to these stringent rules. But generally speaking, it's an area where people need to be aware that these non-commercial loss provisions do apply. So generally speaking, what those provisions are looking for is they make taxpayers jump through a set of hoops. So there are four broad tests. Two of them are not so important to arts practitioners. They're more aimed at the farming categories. They're tests which talk about a business having $100,000 worth of business assets. So the business has made a loss, but it's got a lot of plant and equipment involved in the business, and you're thinking your combine harvesters and all that. Yeah. A lot of artists would not have $100,000 worth. I mean, some of them would have a fair amount of plant and equipment involved, especially film and TV, all of that sort of equipment, musicians. Whether it's $100,000 is another case. Another test is having $500,000 worth of business real estate, and this is because of the nature of how farming land and buildings on that land are sort of utilised in those businesses. So those two aside, the other two remaining tests are the ones that affect us much more, and that's what they call a profits test and an assessable income test. So if your business has actually made a loss, if it has also earned at least $20,000 worth of gross income, then your business is seen to be, at least it's existing, it's actually generating money, it's generating at least 20,000, which is where finally a monetary threshold does come in. It just happens that for all the 20,000 that you've earned, you've you've spent 20,000. In fact, you've spent more than that.
Yeah.
And especially when the business is early stages and you're trying to invest in it and grow and buy the equipment, it's very easy to spend everything that you earn and some. So if you happen to have got to that $20,000 mark, even if you've spent more than that, you've spent 25, you've got this $5,000 loss, and the question is, can I use this $5,000 loss against my other day job? The answer to, I would say the short answer, but it's not, it's a long answer.
Yeah.
The long answer to that is yes, you can get over the line. There's another test which talks about profits. Now the business needs to have been in existence a little bit for this to come into play, but they talk about even though the business has made a loss in the current year, if we can look back over the previous 5 years, including the current one, so this one and 4 years prior, if there's a pattern where there has been profits made in that business in 3 out of the 5, then they will also look to the business and say, look, you've got a loss this year, but in the arts that can be very common, peaks and troughs. A business can ebb and flow between profit and loss, but so long as we can see that there's been profits in 3 out of 5, we'll allow this loss to go through to the keeper, which is another one of those hoops where if your business happens to fit that category and it's made a loss, it'll be okay, and you'll be able to deduct it against your wage and salary activities. And for certain arts practitioners, there is an actual exemption from all of these tests, and that is that if your other income from the part-time, full-time, casual employment, and other income too, and that might be interest from bank accounts and share dividends, investment income, rental properties, it could be anything. When you look at your other income sources, if that income altogether is under $40,000, which is another monetary type of threshold, if it's under $40,000, then a professional arts business exemption comes into play, which says we know that your art practice has made a loss, and we know that you've got other income, but it's underneath a particular threshold that we've just set. It is completely arbitrary, it shouldn't be there, but it is. Those taxpayers will be able to get those losses deducted against their wages and salaries.
There we go. Thanks again to Matt Tucker from Creative Crunches for taking the time to answer these questions. If you have a tax and finance question of your own that you would like to ask, please pop it in the comments below and I will do everything I can to get that answered, or link you to one of the other videos where it may already have been asked and answered. Also in the description below is a link to the playlist that contains all of these tax and finance questions, so you can dig through there and see if your question has already been answered. And of course, it would be fantastic if you could like this video, subscribe to the channel, but most importantly, if you got something of value out of this, there is a good chance you will know somebody else who can as well. Please share it with them, tag them in the comments, whatever you've got to do, pay it forward so that we can keep helping each other out. Thanks very much. I'll see you on the next one.